Hi, March 6th, 2021, John Ward with the Nash Cashflow Group. And I did want to spend a little time addressing an issue that or a question I get from business owners that are looking to put as much money away as they possibly can in their own 401k. But now that they know something about the infinite banking concept, they're wondering if this is the best thing for their employees also. And I wanted to share a video that my friends over at Truth Concepts have put together. And it's really just addressing some of the real factors that are involved in setting up a 401k. And they utilize an example of the employer contributing to their own 401k plan, and then what some of their costs are and so forth. I probably will stop the video from time to time just to make sure I make certain points that Todd Langford is making within the video. With that said, I am going to begin.
We're going to do a 45-year-old business owner in the qualified plan. So, and this is something that we definitely run into a bit. So let's say they've got $500,000 in their qualified plan currently. We'll do the same 8% to start with. Let's put a payment of $25,000. Let's put a match of $25,000. And let's.
I'm just going to make a quick note here. What he's showing again is the employer putting $25,000 into their own plan, and the employer company is actually matching that. And the total contribution to a 401k, whether it be an employee or an employer, in their plan is $56,000, I believe, at this time. You are going to see some numbers here that may or not make sense to you as the business owner, meaning yours are a little bit different. What we're trying to get across is the concept here, and that this might not be the best place to tie up your cash flow.
Let's put taxes in there. Yes. Oh, sorry. Put 100% match. Sorry. Well, that's fine, or a dollar amount, either way. Okay, and let's put in. Let's say he's currently making $500,000, but he's got $100,000 in deductions, so he's paying $400,000 in tax. So clearly, in this place, he's at the 33% marginal bracket. So where is he getting his deduction? At an effective rate somewhere in the middle, or at 33%? 33%. It's last dollar. He gets to take advantage of the top of the bracket on his deduction. All right. You turn on the deferral. So there's $780,000, $5,200,000, 12.1%. And the CPA is just patting himself on the back, talking about what a great job he's done here of saving tax for the business owner. Now, let's look at something, Mr. Business Owner. Who owns your company? Well, I do. Who is matching your contribution? Well, my company is. So who owns? Now, I know it looks like that, but my CPA told me this was a deal because my company can match. That's really my money, isn't it? Yep. And there's a lot of them that are that way, and they've been talked into it. It shows you how much power the CPA has, because the business owner is one that has been brilliant. He's created his business. He knows how things work. And when it comes to the CPA, he just shuts down and lets the CPA do whatever he says and accepts it as the truth without looking at it. Reality is, turn off the employer match and put 50,000 up there. Isn't that really what's happening? So rather than 12.1, he's down to 10.5, still a great rate of return. Now, what about your employees? Yeah, that's the part I don't like, but I get to deduct it, so it's okay. My CPA told me that, yeah, I get to deduct it. So you're telling me you have to put employees in your plan that you have to pay for in order for you to be able to put your money in there. Yeah, that's the only bad thing. How much are you putting in there? Well, I get to deduct it. I've got a cost of employees of $35,000 deductible. So equal 35,000 times 0.67 in his 33% bracket, correct? That's his net cost. Everybody get it? Okay, he's got $35,000 cost for employees. He's in a 33% bracket, so the employee cost is only going to be 67% of that.
Where's the 35,000 coming from?
That's the cost for his employees. He has to put money in for his employees in order for him to put in his 100,000 or his 50,000. So he's got a cost of $23,450, and we can see that brought him down to 8.6, still doing pretty good. Now let's put in the management fee. I'm sure his CPA, who's a buddy of his in college, wouldn't charge him more than 4 or 5% to do it. So now he's got an additional cost, doesn't he? Not only does he have a cost for the underlying investments, but he also has to maintain this plan. He's got to pay his CPA, everything else. What do you think would be reasonable? 3%? Let's do 3% overall. Now he's down to 5.18. Does he have to pay income tax on this when he goes to get the money? Let's see what that looks like. Lump sum, he's down to 1.63% before insurance. How important is cash flow to a business? Everything. And they're going to lock money up in here where they can't access it. And do all that for a whopping 1.63% if everything goes well. That's if he can earn 8% in the market every year. What if he didn't? What if it was only 6 every year?
Watch how this number of net earnings down on the bottom changes when he changes this from 8 to 6%.
How do they get talked into this? Now, I was talking to somebody at the break that said that one of his customers is using it, or several of his clients are using it as employee retention, and that may be the case in some areas. I have yet to meet that business owner. If they could get out of putting their money in for their employees, they would do it in a heartbeat. The only reason they're doing it is so that they can put their money in there. But, like I say, there may be some that are out there. Could we do something else, potentially, for those employees? Could we do a vested life insurance policy where, hey, we're going to own this life insurance policy on you, and if you're here 10 years, you get the proceeds, or split it. There's all kinds of things that we could do outside of that.
Annual distribution after a certain age of...
So I think it's important to point out there's many different options besides a 401k. Yes, you could do what Todd's talking about. Yes, you could just give them the money and let them decide what to do. Bring me in and show them the infinite banking concept. That way they know that they can flow more of the money their direction, maybe make their lives less stressful because they have access to their savings as it continues to grow. So they can leverage it, obviously, through an infinite banking policy, but they never actually take their own money. And so it continues to be a certainty down the road, which is building their own pension. And you can do it through, I'm going to contribute to a permanent life insurance policy for you, and you will be vested at some certain period of time. That might make things more complicated for you. The idea is that they know that they have options to save for their future. But this option we have with infinite banking is that you can save for your future and you can leverage that same money throughout your lifetime for major purchases.
Of, age or maintaining years of employment, and the company
Right.
keeps the policy.
Yep. How many, I guess my question would be, do employees really appreciate the qualified plan world? Statistics show, I wish I knew what the exact numbers were, I shouldn't even throw any out here, but I think it's in excess of 75% of people that quit a job or lose a job, cash out, pay the taxes and penalty on their qualified plan. That tells me they don't really appreciate it too much.
I just want to add or make a comment to that. I'm not sure that he really means that they don't appreciate it. What they don't appreciate is the money that they put aside, and when they're in need, when they may have lost their job with you, maybe you had to downsize. Now they have no savings, they have no job, other than maybe some unemployment income. They have no income, and for them to be able to access the money that they put away, I'm sure they're fine paying the taxes like they do, or, I say fine, but to be penalized to go get the money that you put aside is just wrong. And so I think it's not that they don't appreciate what you've done setting up a 401k, is that they don't really feel good about the fact that the government is now going to penalize them when they're in a time of need. With an infinite banking whole life, permanent whole life policy, you still have access to every dollar that you've put away into your own privatized bank. So with that said, I want to just say thank you and hope you have a good day. If you have any questions, you can reach me at 603-479-2511. My email address is john@nashcashflow.com. And I want to finish with that idea is, why did I name the company the Nash Cashflow Group? Well, I wanted to honor Nelson Nash, the creator of the infinite banking concept. So I used the name Nash. I thought it was a nice ring to it, Nash Cashflow, because what we know about infinite banking is just like all pools of money, all pools of water, they need to continue to flow, to be energized, to not go stale. That's what the commercial banks do. They just show on paper that your money is in there, but they're moving the money all the time. And the benefit to a business owner, obviously, is to have constant inflows, because you're going to have some outflows. And so setting up your own privatized banking system is a way to always be sure that you're going to have access to basically a line of credit, but you are also protecting your loved ones, and you are not in jeopardy of losing your business based off of not being able to pay on time with lines of credit, or to pay down lines of credit, or pay down debt. You have total flexibility within the infinite banking concept. Hope you have a great day.